Hi everyone, welcome back to Be Rich. I have Shaswat with me. Yes, we have been seeing the markets move around. We've done multiple videos on specific stocks, and we have talked about what the FIIs are doing and what's happening in China. I do feel all that news is temporal, and as a value investor, it really doesn't give us anything than just some incidental news like office gossip. It really doesn't change our strategies which we have in place and what we call the company deep dived and studied in. Whenever they do come into value, when the market feels like giving it on a sale, we tend to pick them up, and that's what we've been doing. So with that in mind, I thought we'll have Shashwat on and talk about investors' mindset. What are the kind of metrics you should keep in mind? In these volatile times, you hear about a company, you need to value it quickly and see the valuations are correct and pick it up. Let's say someone tells you about a company and they say they're also a value investor like you, and they give you a new company which you have not heard of, and you need to find out quickly if it is something you should do, if it's something you should be interested in. And it's really not in your circle of competence, but it's in your peripheries, and you trust your friend, your resource. So, how do you value this company quickly is what I want to talk about. And Shashwat can give us some insight on this. Yes, Shashwat. So, what do you have?
Right. So the metrics we're discussing today are a collection of what Warren Buffett looks at in a balance sheet. How Warren Buffett reads a balance sheet from a 10K. And this is something which applies to the US. I know a lot of our audience is interested in investing in the US and they want to know how to analyze US stocks. So I thought we could talk about this topic where this author known as Brian Feroldi has collected five metrics which Warren Buffett looks at in a balance sheet. So this is how we're going to be looking at this video. Now, the 5 points will be flashing on the screen and we're going to discuss each one. So the first point here is a point of cash versus debt. And that's basically that cash and cash equivalents should be greater than the long-term debt plus short-term debt which your company has. If it has more than the long term and short term debt, that means your company is very healthy. So, this is the first metric which Warren Buffett looks at in a company when he decides whether to invest or not. So, if their debt is much larger than their cash and cash equivalents, this is the same as us looking at the reserves in a balance sheet, then you pretty much have a company which Warren Buffett may not be so interested in because a lot of their business is debt financed, and debt is always a very volatile thing, as we have discussed before in this channel. So, what do you think about this first metric?
I completely agree. Debt is like cancer, and and if you're not on top of it, yes, it can kill you. Cancer is maybe too harsh of a word. Debt is probably like being overweight, being obese. I would say probably would be a better example because some debt is good. You don't want to be too lean. Depends on what stage your company is in. What stage of growth you're in your corporate cycle, and based on that, debt can be very useful. But the problem with debt is you cannot time the market. You're making a great strategic move in your business and you're expecting certain revenue streams to come in from your sales. And because of the revenue streams coming in that sale, you're like, okay, let's expand and take on this debt because we have a steady stream of revenue coming in. And, as a business CEO person, you might be like, okay, there's no problem. I can look at the sales of the last 2 years and see that it's coming at least this much sales we can expect. And you take on the debt. Lo and behold, the market goes through a recession or worse, some financial crisis happens. And the product which your company sells is very recession sensitive, meaning when people don't have money, they tend to avoid buying this. They consider it maybe a luxury. It's not a recession proof product. So suddenly your sales start declining and you still have debt to pay. And suddenly what was looking like an easy win becomes very tough. This has even happened to the Tatas. It is not something new. It happened to Tata Steel. If we read the history of Tata Steel way back in the beginning, what happened to them was that exactly. They were very keen on expanding their capacity and they went and ahead and took a bigger expansion plan than they initially thought of. Then the founders had to go pledge their family jewels to pay salaries. So that story is synonymous with debt. Yes, they were lucky to escape because they had personal assets which fished them out. Otherwise, Tata Steel won't be existing today. And even to commemorate that sacrifice the founders had made, there's even a statue in Jamshedpur to mark that part of their history. So debt is something you have to be very careful of. Even the great Tatas were shaken by debt. So it's just to tell you that debt does not pick, sides. It's even on everybody.
Yeah. Then there's a second point, which is again an extension of the first point, but a different metric to look at debt, which is known as the debt to equity ratio. So, according to Brian Feroldi, Warren Buffett's rule of thumb is that the ratio has to be lower than 0.8. But what that basically means is that the total liabilities divided by shareholders' equity. So, at most, 80% of the equity can be basically from liabilities. If you look at the size of equities, for example, if the company's equity equivalent is, let's say, 100 rupees, at most the equivalent liabilities which the company should have is about 80 rupees. If the ratio is out of whack, in the sense that if liabilities are much larger and equities is very little, that means that the company is preferring to finance its operations through debt rather than equity. And as we all know, it's always better to raise money in the market, which is permanent, and then you get to keep that money rather than just taking on a lot of debt to finance your operations. So a lot of the times when companies don't have the option to go to the market and issue more shares, maybe because their stock price will go down, then they tend to go and take on more debt, because that may be the easier and faster option to go about things. But like what Warren Buffett said, if you take the easier and faster option all the time, then you're probably not going to have a company which is doing the hard thing most of the times. And if you're not going to do the hard thing, company is probably not going to survive hard times. So this is the second point. So what do you think about debt to equity? Maybe a quick comment on that as well.
Yes, best way to raise company should raise money is through the market by issuing fresh shares. And if you have a product, you have a company or a service which you're doing and it's doing great, and you need more capital for expansion, you should definitely reach out to the market. The reason why you don't see that happening in India too much and people borrowing more is because simply the owners don't want to dilute their positions. The promoter doesn't want to let go of the grip he has on the company. So they tend to take debt, because when you go to the market and you're issuing fresh equity and you're bringing more investors on board, in percentage, your value on your company, your hold starts diluting, and that's something they don't want to do. Most promoters don't have personal wealth so that they can infuse cash into the company themselves and take on equity. Because then they suddenly feel greedy about it. They'd be like, why should I put my money in? So human nature is such that even if the person has a lot of cash, you don't see them putting it into, like you see in Vodafone. The Billas have more than enough capital to inject into Vodafone idea and do turnarounds and do everything. But they seem very resistant. But he'd rather take that same capital and start a new line of business. But he doesn't see, injecting fresh capital into Vodafone would be great. He's trying to raise debt from here and there and trying to find different ways to tell everybody else, come on, I already have enough pain. You take on some more pain for me. At the same time, he's having a stranglehold on the company too. So I don't know. This is the problem with human nature. And Shashwat is absolutely right. It kind of gives you the working culture, the philosophy of the owners, the promoters, and also the management of the team, the quality of the company management team. If they don't want to, take the harder route of giving fresh equity and asking markets truly, do you think my product deserves this kind of more equity? You're asking. Honestly, it's like asking your friend, asking him, saying, how did you think my food was what I cooked today? It's like asking him that. Sometimes you don't want the opinion and you tend to avoid it. So I can understand that. And taking on debt, you'll be fooling yourself if you think your product is great when it's not. So you should be careful.
Yeah, and I know I can already envision some comments saying that, but Vinod, what about companies where you basically said you need a promoter holding of over 60%? Doesn't it make sense for a company with almost 60% promoter holding to raise debt rather than raise money through issuing more stocks? Because then that would ruin one of our metrics of that 60% mark. What
No,
would you say?
let me argue over there, saying if you look at the American companies, most of the big companies in America are not founder driven anymore. They're all professionally run, professionally managed. India is also going through that maturity phase right now. The reason why we talk about that in India very specifically is because India is still the wild west when it comes to equity markets and companies. We're still very nascent. We're trying to understand how companies, promoters work in India, and there's reliable data is not there. Meaning, if someone's providing you some data, you can't scrutinize the data and take them, at their word and say the numbers which are showing me are absolutely true. More and less people fudge numbers here. So that's why we look at the promoters, saying that if the promoter himself is holding on to the company, that means he himself has got a lot of skin in the game, as to say. But this is not true in the US, where it's a more mature market and regulations are far more stricter. The numbers are far more reliable. I'm not saying that US is free of all this. It's there, but the percentage of it being there is much smaller. And especially when you look at big companies, it's much smaller. So, yes, what you say is true, but you have to see everything in the lens which it needs to be seen in. You just cannot take one metric and apply it for everything and say, ha. Like you cannot take PB for everything and say, I'll do PB when we say use PB only for finance companies. So you have to, compare and contrast and see how it goes. So it's a good question, though.
Yeah. And just a point of clarification here. I know that a lot of you might be wondering why Warren Buffett is tolerant of debt when we ourselves, when we look at Indian companies, we like to look for debt-free companies. Well, the reason is in the US, there's always a culture of having some debt in your company. So it's almost unavoidable. If you've looked at a large blue chip company in the US, most of you have probably seen that the company has some debt on the balance sheet. So this is something which Warren Buffett knows, and it's unrealistic for him to have the same metric we do. So this is especially in the US context. So the third point here being preferred stock. So he says that the company should have zero preferred stock. It should have none in the balance sheet. We should not have any preferred stock issued by the company. So for those of you at home who don't know what a preferred stock is, time to hit the books. I'm joking. The Intelligent Investor talks about this in chapter, I think 3 or 4, I'm not sure, but if you open it, you will be able to see it. Preferred stock is basically a variant of common stock or ordinary stocks. But the difference here is that preferred stocks give you a higher dividend yield, but I think you forego your ability to vote on decisions which the company has put up for vote. And also, in a given amount of time, I think preferred stocks some of them can be converted into common stocks in a certain ratio. So the reason Warren Buffett likes to own preferred stock but doesn't like to have companies which issue preferred stock is because it's almost always skewed in the favor of investors rather than in the favor of companies. And so if you're able to get your hands on a preferred stock of a company which is able to pay out that amount in a good fashion, then it's almost a better deal for the person who's buying it rather than the person who's issuing it. So that's why Warren Buffett believes that there's no place for preferred stocks in his company. So what do you think about this point?
I agree. Preferential treatment is always frowned on, especially when you're not the one getting the preferential treatment. When you're getting the preferential treatment, you don't mind. You'll be like, it's okay. It's how the system is. But the minute you're not, it's not good. And he's right, because getting your hands on preferential stocks is much harder. They're more expensive, and they're not really traded as much as the other stocks are. And as a beginner investor, it's something to be very careful about, because these are things you don't usually pay attention to. You just look at the name and you think everything is nice, and you look at the price and you think it's nice. And one of the first things beginners fail to see this is preferential stocks. And it makes sense. What Warren says is absolutely true. But in India, I don't think preferential stocks are so rampant.
They don't exist in India.
Yeah, this is more of an American thing.
Yeah, it's an American thing. Fourth point, retained earnings growth. This is something which can be applied to India as well, but mainly in the US, because this entire discussion is oriented towards the US. So if we look at retained earnings growth, this is something which applies to any market, any company, be it Europe, US. Even if you're investing in China, for example, I don't know how their balance sheet works, but I'm sure there should be retained earnings in their balance sheet. This is something which you have to look at. It's you look at the growth between the second year and the first year in terms of the retained earnings, and you see whether the retained earnings are growing. So retained earnings are important because this is the free cash flow left after all the capital expenditure and everything else the company has to do. This is the amount of, after paying dividends, this is the amount of money which they have left, which they're keeping inside the company for the operations of the company. So this is an important metric. I completely am in agreement with Warren Buffett here. I think that this is something which is going to be very, very fundamental to whether a company is healthy or not. And I mean, the first point ties into it, right? If you can't have growing retained earnings if you don't have
No,
cash and cash equivalents much higher than your debt. So that's something which, yeah. What do you think about retained earnings growth?
this is the metric which Sashwath loves the most, and that's why he keeps like saying like Warren. The reason he likes Apple is because it's spewing cash all the time. Even Warren's own company, Berkshire Hathaway, is spewing cash right now in the sense on the stockpile it's sitting. So, it's basically cash is always king. Even in companies, believe it or not, cash is king. No matter what you're doing, if you've got a huge surplus, like what Shashwat is saying, and it keeps growing and expanding, it's good news as an investor, as a business owner.
It is. And finally, we get to the last point, treasury stock. So, this might be a little ambiguous to a lot of us, but treasury stock basically talks about the stock buybacks which a company does. This is listed as treasury stock. So, the stocks which are in your treasury is these are basically shares which the company itself has bought back from the market. So, there are a few things which a company can do with these treasury stocks. One, they can reissue it back into the market when they want to raise some funds. Two, they
Correct.
can extinguish the stocks to increase the uh, shareholding
Right.
percentage of
Value. Yeah.
yeah, of everyone else. So on the topic of Apple, the reason why Warren Buffett was such a big fan of Apple is because Apple kept doing stock buybacks because they were generating a lot of free cash flow stemming from their moat of being Apple and having a big advantage on pricing power in the market. They were basically able to generate a lot of free cash flow, and they rewarded investors by buying back Apple shares. And Warren Buffett liked this because I think he had like a nominal percentage of Apple, and the percentage of Apple he owned kept growing without him putting in any additional money. And I think there's this video of Warren Buffett talking about the beauty of Coca-Cola as a company, where he says that he bought only like 6% of the company and his shareholding went up much more because Coke has been doing buybacks every year. So, what do you think about this point?
It's a fabulous way to grow your holding in a company. It basically means people are not able to, it's like playing musical chair. The chairs are being removed, but you don't need to bother about getting and running around because you own the chair you're sitting on. So everybody else seems to be running around trying to grab a chair as chairs are being removed. But you can sit like Warren Buffett and relax because there's no pressure on you to sell your chair. Finally, the number of chairs will keep dwindling. Whomsoever is finally left when the music stops are all the guys who are laughing all the way to the bank. It's true, but it's a very hard thing to do because most investors get tempted when share buyback happens, like you spoke about in the last video about arbitrage, how you bought TCS.
Yes, yes, yeah.
About, yeah, TCS, you were looking at it. But fortunate for you, you didn't get that additional share and
I
you just
did.
missed it. Yeah.
Yeah.
But now you're all happier for it because you ended up holding onto this stock. And it's an important lesson to learn. And Warren is saying this. I hope a lot of investors look at opportunities of buybacks the other way around, saying that by not selling, you are actually growing your percentage of holding in the company.
That's a good point. Even I didn't think of it that way. Yes, I mean you'd never generally connect buybacks and the company, but yeah, it's true. If there's a buyback, then you can look at it as a reverse opportunity where you hold on to it and your holding goes up. I mean, yes, it's not for free. Your company is spending retained earnings on it, but how else would you prefer your company to spend it? It could instead be
Correct.
blowing its money on something else. Rather, it's rewarding its investors in a tax-free format, which is always something which I appreciate, given the circumstances in terms of taxation in India, especially. It
True.
makes a lot of sense that the company doesn't reward its investors through dividends, but rather through buybacks and other avenues, which basically cannot be taxed by the taxman. So this is
True.
something which I find preferable as an investor. So that being said, these are 5 points. So what do you think about these 5 points which Warren Buffett has given us?
I think these 5 points are fabulous as a back of the hand way to quickly look at something. Of course, doesn't mean if all these boxes are ticked, it means the company is immediately ready to buy. It's not a buy. Price you have to see, where the market is you have to see. You have to see your own capital, your own risk assessment. All those are also equally important. But this is an immediate flash. By looking at it at a glance, you can say, is it worth exploring further? That's what this will help you do. It will help you to say, okay, should I be exploring this company? Should it be on my list? Should it be on my radar? It should help you do that. Not immediately tell you to go take some of your tiffin coffee and throw it at it. Is what my advice would be.
Yeah, and I mean, one policy which has always something which I've followed, and I'm sure you and my other uncle follow, is that if something's interesting and sounds interesting, and something like these, we have our own 5 metrics, which is very similar to these 5 points which you've seen, which we look at in a company to immediately assess whether it's something worth purchasing. And we've discussed many of those points on this channel. Something which we do is we look at it. If it seems interesting and promising, we just buy 1 or 2 shares if it's cheap enough to keep our mind on it and keep our eye on the ball. Because a lot of us have this habit of saying, okay, I'll get to it, I'll get to the analysis later. By the time we get to it, we find out the company is bounced up by 20%. And then there's this sense of pain which we have because we were not keeping track of the company and we lost out on a good opportunity. So if you have back of the hand calculations to make like this, then you basically have a way to assess whether you're going to be making a big mistake jumping into an opportunity. And if you're avoiding any big minefields, then it makes sense to maybe buy 1 or 2 stocks in it in the tiffin coffee range, just to make sure that you have your eye on the ball and you don't lose track of this company which you had found promising. Maybe 2 days after the analysis, you find out the company is not worth it. Just you can dump it. You're not going to make much or lose much by holding it for a day or two. But the practice of buying 1 stock or 2 stocks of the company for 30-40 rupees is just going to keep your eye on the ball, because when you check your portfolio, you're going to see that flashing in front of your eyes. So that's something which I've always found which works for us. So yeah, that's about it. Do you have anything else to say?
Other than that, nothing else. I hope you use this checklist that Sashwath shared with you. Do let us put in the comments down if you found any gems like this in the American market or in the Indian market, which other people who are reading comments can also join in and share their views on this. And do like and comment down below. Share this with friends and families who might find this content interesting and informative. And as the markets are correcting, it is turning more volatile because, like I said in the Instagram post, what foreign investors are doing, especially in the futures market in India, shows clear signs they're looking at it in a very bearish light. So be careful out there. If you are looking at purchasing stocks, look at it individually, stay in your range. We have not seen a huge crack, as they say in the market. These are small corrections. Individual shares have moved, like Tata Motors have moved, Manappuram have moved, but the movement might be even more in severe in the days to come, or may not. So that's why I'm saying stay within ranges and be safe out there. Anything else, Sashwath?
No, thank you for watching this video.
Thank you.
Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.